Hi, everyone. Thanks for listening and welcome to this edition of the PE Pulse podcast, where we'll break down all the important trends and themes in the private equity space and fill you in on what you need to know about today's market. My name's Pete Whitty, and I'm part of EY's Private Equity Group. And over the next 7 or 8 minutes or so, we're going to unpack some of the major dynamics in the private equity space. And we have got a lot to talk about. The environment has changed pretty dramatically since the last time we did this back in March. Inflation in the US and Europe has spiked to about 8.5%. We expected that interest rates would move higher, and now they have. So the Fed bumped rates up 75 basis points in June. That was the highest increase since the mid-90s. Global markets have headed into widespread correction territory, in some cases, the US in particular, actually moving into a bear market. So we'll start with a view of where we are, and then we'll move into some thoughts around where we think we're headed. And if you look at where we are right now, in a nutshell, it's this, right? We've seen some measure of deceleration from last year's pace, but for now, at least, activity is still above pre-pandemic averages. In the first half of this year, private equity firms announced deals valued at about $486 billion. And that's down about 18% from the first half of last year. But remember, last year was a record year for private equity deals, and it wasn't even close. About $1.2 trillion in deals announced over the course of last year. So we're coming off a really high base when we make these kinds of comparisons, and that's worth remembering. And that's based on value, right? When we look at the volume of activity or the number of significant deals, that is deals valued at $100 million or more, before the pandemic, we were looking at about 40 or so of those deals every month. Last year, typical month, we'd see about 70 of those deals. Right now, we're at about 50. So again, the theme here is deceleration from last year's highs, but still above where we were before the pandemic. And that's really the best way to describe the market right now. So I just got back from Super Return a couple weeks ago. Super Return is the largest private equity focused event in the world. Every year it's held in Berlin. This year it pulled together about 4,000 private equity folks from around the world. And obviously, the volatility in the macro situation was top of everybody's mind. What does it mean to deploy capital in this world of rising interest rates and slowing growth, geopolitical instability, and so on? And what I think we're seeing is that investors are striking a more cautious tone, right? Folks are underwriting recession later this year, early next year, into their base case scenarios where that wasn't really the case back in March, which, makes sense, right? That's essentially the consensus view, or at least a significant minority view at this point. What was more interesting for me, however, was the optimism that we heard. Historically, volatility has created a lot of opportunity for private equity firms. And I think across asset classes, investors are looking for those opportunities to acquire high quality assets at better pricing than they could get 6 months ago. And in particular, they're looking for assets with characteristics that are going to let them perform well through the downturn. So long-term contracts, for example, high barriers to entry, for example, and they're avoiding anything that looks or acts like a fixed rate bond. From a fundraising perspective, we've seen declines of roughly a similar size, down about 15% in the first half of this year versus last year. And a lot of the activity that we have seen has really been driven by the large-scale buyout funds, right? Much more so than the growth equity, for example, that we saw over the course of last year. So that's sort of the overview of where we are. Now let's talk about the piece that really matters, which is where we think we're headed. I think we should expect to see deal-making challenge over the short term just because of this widening expectations gap between sellers who want the price from 3 months ago or 6 months ago and the buyers who want today's, right? It's this temporary imbalance that, we typically see in periods of excess volatility that, tends to resolve in time. I do think it's possible that we see rising interest rates initiate a shift from investment strategies that are predicated on this growth at all costs orientation toward a value orientation. We've seen valuations rise monotonically in recent years, topping out at about 11.5% last year. And in a lot of deals, especially in the growth equity space and the tech space and so on, trading much higher. If we do see valuations fall, that'll allow firms to stay active despite higher costs of capital. And in some cases, we could see value players that have been sidelined by some of these high valuations start to re-engage with the market again. Now, what it's also likely to do is elevate the role of operational value add. You think about the levers that private equity firms have to pull, right? Leverage is getting more expensive. We're entering this period of contractionary environment for multiples. And so it's value creation, right? All the roll up your sleeves type work of supply chain management and pricing optimization, digital transformation, working capital, and so on, that's going to be the primary driver of returns. One of the panelists at Super Return put it pretty succinctly, right? Everybody has been levering as much beta as they could find. Now we're going back to the roots of value creation. But I think the good news is that the ecosystem is better prepared for this than at any time in its prior history, right? Firms have made the right investments, they've built out these operating capabilities, and they have the right resources to respond to that. Now, from a fundraising perspective, I think it's worth noting that we could see a short-term pullback in fundraising, right? We mentioned the 15% decline so far this year. I don't think we should be surprised if we see that decline grow larger over the balance of the year. You think about the velocity of fundraising, for example, and it really has increased pretty dramatically. 10 years ago, maybe a flagship fund was raised every 5 or 6 years. 5 years ago, it was every 2 or 3 years. And lately, it's been every 1.5 to 2 years. And there's LPs out there that are feeling tapped out, and the denominator effect, right, which is where your public market holdings fall faster and steeper than your private market holdings, making you suddenly oversubscribed to private equity, are only going to compound this. Now, that said, the practical impact of that decline is pretty de minimis. PE firms, they still have $1.2 trillion in dry powder. They're not going to be capital constrained. LPs are committed to the asset class. They're not market timers. They're going to continue to do their best to invest at a steady pace. On the exit side, we've seen a pretty steep fall in exit activity this year, at least through the traditional routes. Overall, exits down about 35% year over year. And that's really because two of the routes that were on fire last year, right, which is sales to SPACs and IPOs, are basically closed off, down 94, 93% respectively. What's interesting, though, and we've talked about this in prior podcasts, is the development of the PE secondary market, which is the trading of LP interests, which is distinct from secondary exits. That market has grown tremendously in recent years, going from maybe $5-10 billion every year to more than $100 billion over the last couple of years. There have been massive secondary funds that have been raised. There have been other new entrants to the market. In recent weeks, we've seen some pretty significant secondary deals announced. So that's going to be a really interesting dynamic given some of the market conditions that we're seeing. The other interesting dynamic is really around private debt. Remember, most private debt is floating rate. And so there's a sense that even with all of the growth that we've seen in that asset class over the last decade, this is really its time to shine. And over the last several years, we've seen more and more of the syndicated markets shift over to the private side. And with the volatility that we've seen in the leveraged loan space and the high yield space, this shift is now particularly acute. And so it's going to be a really interesting 6 to 12 months for this market. So to wrap it up, market volatility, inflationary pressures, and rising interest rates certainly make the landscape a lot different than it was 6 months ago. That said, we think that firms will stay active despite that increased uncertainty. That's exactly what we saw during the pandemic, where PE firms were among the first to return to deal making, initially with pandemic-friendly themes like credit and pipes, and then later on placing bets on post-pandemic winners, especially in the tech space. LPs are well aware that a lot of the best deals are made in the most challenging of markets. So certainly a challenging period that we're in right now and that we're entering, but also one with a lot of opportunity. That's it for today. Thanks for listening, and we will see you next quarter.